Hi everyone. I thought I'd record a brief update elaborating on some of the points I raised in my last letter, which actually got a fair bit of feedback. So I will push through with that. So last week was quite a big week. The US Fed raised rates by 25 basis points from 4.5 to 4.75%. But critically, there was the first acknowledgement of disinflation by Jerome Powell. He said that word more than 10 times and continued that in a speech afterwards. This triggered a huge rally in the Wednesday and Thursday of that week. And it was a real rotation in the sense that, last year there were some days where there was an awful rotation, for us anyway, out of growth into kind of steady, non-growing stocks. The exact reverse happened last week. So if you think about how everyone's positioned throughout last year as growth sold off and underperformed versus relative to everything else, that's basically caused by investors positioning in that direction. Most people expect, anecdotally and also through forecasts, inflation to last for quite some time, and are also expecting the Fed to be tight for quite some time. So this acknowledgement of disinflation certainly does change things. Now, the next thing that happened was on Friday, a really strong jobs report came out. Now, there's two sides to this. On the one hand, that was one of the biggest two-day rally in growth stocks relative to the market, in recent times. But a hot jobs market suggests that rates will continue to rise further than expected. So that was partly reversed on Friday, but pretty sharply. But the reality is 500,000 jobs, that is not a recession. So for all the calls for recession by now from last year, that hasn't happened. You've got 500,000 people with more with jobs, that are then putting money to work, saving, building wealth, and that's reflected in the stock market. And if we don't go into recession, then that leaves the professional investor community significantly positioned the wrong way. It seems like anecdotally and also certainly by the end of last year, when you look at positioning in prime broker reports and things like that, the professional community was very underweight, tech in particular, and positioned very conservatively. There were times last year where positioning got into, the 98th, 99th percentile. So if recession doesn't come, then you have all the ingredients in place, which have, to be fair, been there for 6 months. You have all the ingredients in place for a sustained rally and a major low from mid and late last year, which wouldn't be too surprising given that's kind of, what happens with markets. Big sell-offs that last longer and go deeper than expected, followed by recoveries and then long, slow, grinding rallies that, climb that wall of worry. I thought I'd elaborate on this chart, so I put this in my note. It was interesting because I sent that out before Powell started talking about disinflation. Before that, the talk was unanimously about inflation. But what I've done here is I basically extended the trend from the last 6 months, or really from June 2022, including January's number. So you can see on this chart, the blue line, price levels have been flat since then. So if you read the newspapers, you'll hear them report 6.5%, 5.5%, like very high numbers. But all that's a year-on-year number, and it includes the really high inflation months from the first half of last year. Now, every month that passes, those high inflation months roll out of the data set. And that's why you see this black line, which is the year-on-year inflation, plummets rapidly. So at this rate, it will be kind of below 2% by May. Now, this isn't kind of, high inflation, high rates kind of triggered the sell-off. Inflation falling doesn't necessarily mean, speculative stocks go off to the races. But no doubt, strong companies that are growing will almost certainly do much better once we see the end of this. And interestingly, if it's true that inflation kind of peaked late last year, then that would tie in with a historical analog where markets kind of bottom at the peak of inflation. So kind of two bottoms, one in late June or one in late December. And so far, this sell-off is actually following the script of prior inflationary bear markets, where the lows seem to coincide with a peak in inflation. And the key thing is in the 80s and the 70s, mid-70s, those were like lifetime generational lows once inflation kind of rolled over. The markets rallied from the early 80s with a hiccup in 1987, 1991, of course, largely rallied through till 2000. So these were huge moves, and you can see how it happened because we just went through one of those. The positioning goes from all the way one way to all the way completely in the other direction. The other interesting thing is, that gives us conviction over that. My view that chart that I showed where inflation just kind of drops off, that only kind of flatlines inflation at the current rate. But really, the reason inflation isn't already significantly negative, and we have had negative numbers, like last month was December came in at minus 0.1%, for example, is due to shelter. Now, rents have risen rapidly. The people that picked the inflation rate rise correctly basically looked at data that was coming in, live data, and said inflation's much higher than it is coming through in the numbers, but it will come into the numbers with time, as night follows day. And there's like kind of delays built into these data. For example, most people don't change houses, but really in the rent calculation, it only takes into account the small percentage of people that do in a particular month. So it's always a significant lag. And I say this, I'm mentioning it's very good at predicting the increase in inflation just to show it's not one-sided. This gave a very good indication at early 21 that inflation was about to pick up, and this was going to flow through in the actual numbers, in the official numbers. It would just take some time. And now we're seeing the exact opposite effect, and in fact have for most of 2022. And that's just starting to come through the numbers now, and that's yet to come. The other thing that's yet to come is actually the rate rises. So, economists typically think that there's a significant lag between increases in interest rates and their effect. But we just had a rate rise last week. So when I say if you flatline the price line in official numbers and you're below 2% by May, that doesn't take into account these other reasons to think the inflation is coming down. Now, of course, inflation could accelerate, but in my view, it would take something would have to happen to cause that. This is assuming the world roughly, continues as it is. Or maybe it would be another war or something like that. But it's worth noting that that was pretty rare. A confluence of post-COVID, backlog of shipping, backlog of cars, difficulties in all kinds of supply chain, combined with monetary stimulus. That was kind of, and the war in Ukraine, of course, that was all quite unusual. It would take a lot to get that same mix of circumstances. But at the moment, this is what the data is saying. So these are not my numbers. I haven't calculated these. I'm literally just, the one chart I did calculate, I just extended the official statistics. And these are live statistics from for example, in rent, anybody can download and see the, apartment prices and rents are publicly available data. So it's very easy to create real-time indices and see what's happening. The other thing that's interesting is you had this kind of idea of breadth thrusts. So if you followed these, you actually did pretty well. So you can see in 2003 and 2009, companies using this metric, which is number of companies in the S&P 500 below the 200-day moving average, during the sell-off, this number plummeted and stayed there. And it stayed there until the very beginnings of the recovery. So this is like kind of April 2009, January 2018, April 2020, the beginning of rallies. And then all of a sudden, everything just like shot above the 200-day. This chart went from like right at the bottom to right at the top. And that was the beginning, in all these cases, of multi-year rallies. That was the sign the lifetime low was there. It looked like we're having that at times last year, but the signal never came. The breadth thrust kind of went halfway there. It never went all the way. We're kind of getting there now. And that also fits in with the rest of the data. You're also seeing charts like the NASDAQ new highs minus new lows ticking up for the first time. And again, this fell for over a year. And now for the first time, it's ticking up. So a lot of things happening under the surface that are kind of suggestive that perhaps the worst is past. Now, fair criticism is I'm very much a glass half full person, and that pays off, 4 out of 5 years. Last year was not one of those. But this is all, again, I think this is pretty clear what's happening under the surface. And it'll really take a shock to kind of push things in an opposite direction. I was going to share this at the beginning of the year, this chart about Chinese tech. We're not actually invested in it at the moment. Just kind of got sick of those constant policy announcements. And also there's plenty of growth stocks outside of China. And actually, I think it's the United States where the biggest opportunity is now. But you can see that, a few months ago, this was the worst possible place to be. It was over 80% drawdown in the index. But it only took a few weeks, basically, or a couple of months for that index to almost double and many of the stocks to do twice that. So things can really change. But once things started changing, all of a sudden everybody piled back in. And you'll see, my view is you'll see exactly the same thing in technology, and perhaps we're already seeing that. Another chart I shared in that note was this. This is the cloud index of cloud computing stocks. So you can see from the low in 2016, this index went up 12 times in 5 years. roughly 5 years. And even after the sell-off, where this thing lost two-thirds, I think more than two-thirds of its value, it was still up 5 times from that low. Now, the reason that's interesting is these are substantial returns for an index for a large collection of stocks. But we reached those valuation levels. So we've reached the same levels that were reached in 2016. We reached at the end of last year. And the 5 years following those, like I said, the index went up 10 times. Many companies did much more than that, certainly the faster growing ones. And on a growth adjusted basis, this chart, which was put together by Morgan Stanley, shows that we're actually much cheaper than we were in 2016. So that's the opportunity. That's why even though we had a very bad year last year, it's still very much in play, because those kinds of moves are more than enough to get us way back on top and well ahead of where we were at the peak. And these baskets of stocks are still hitting 28, 29% average organic growth rates. And they're going through immense cost cutting processes right now, from Salesforce to certainly the much more junior companies. We also had results from Tesla. So I shared this chart because, again, I think people got a bit excited. Tesla dropped about 75% to the end of last year and has now almost doubled from the low. Again, shows how fast things can change. But this chart shows that last year, Tesla grew 44%, GM grew 3%, every other, BMW, Ford, Subaru, Toyota, Mazda, Volvo, Nissan, all these other companies actually shrank. So our thesis was always that Tesla had that customer love, could grow when other companies are shrinking. And this is the second time that other companies have shrunk and Tesla has grown dramatically since we kind of developed that thesis. Certainly talked about it on this podcast. You also see the operating margins from Tesla are actually pretty good and way ahead of the industry. The autos industry is basically flat to negative, and Tesla's so not flat to negative, in low mid-single digit operating margin percentages, whereas Tesla is kind of 16, 17%. Ferrari, which actually trades much more expensively than Tesla, it is an interesting comparable, similar in some ways, different in others. Tesla grows faster, Ferrari has a much higher margin and a much higher multiple. It does kind of show there is method to the madness. So if you want to be richly valued as an auto company, you do need to be able to do something different. You need to be able to charge a margin. You cannot be competing with 12 other companies, because that is value destructing for everybody. And traditionally that has been the case. The other thing that's interesting is semiconductors. So I've been looking at these for a few months now and have written about it in the letters. I was kind of always interested in them because I knew that, firstly, they're generally the best performers over the last 10 years. Many of the best performing stocks were in this space. We largely missed it for whatever reason, felt like it was more of a specialty place, but have done a lot of work on it since. The other thing that's interesting is that these companies are often the best performers after crashes. And there's a long history of this going back, 50 plus years. They often are hit the hardest and then go up many, many, many times on the back end. And it's an interesting point now because computing has never been more important. And with AI, advances in AI, which are massively computationally intensive, suggests there's going to be a big demand shock. So kind of what hit semiconductors was they were kind of hit twice. Firstly, by a cyclical collapse in PC and smartphone sales. Everybody upgraded during COVID and didn't really need to after that. That cyclical demand will come back at some point in the next year or two. There's also a collapse in demand from cryptocurrency. So all those Bitcoin mining companies were buying effectively computing power, computing equipment, and that was a massive, that was a significant demand boost at the margin. That more or less has ended. But now you have this case where, 100 million plus people or something using ChatGPT. And searches on ChatGPT are over 100 times more computationally intensive than, a search on Google. So this is an immense demand shock, which will mean that, the Microsofts, potentially the Amazon AWS and Google Cloud, they're all going to have to kind of upgrade their data centers and invest heavily in that area to meet this increased computational demand. The algorithms are all pretty similar for these AI tools. So there's a guy who's Andre Karpathy, who is the head of AI at Tesla. He put a tutorial up online and in 2 hours on a personal computer basically recreated a ChatGPT tool. Now, the difference between his tool and another tool is mostly data and computational power. So his was able to run on a PC or a MacBook Air, which is what I kind of followed the tutorial on. and basically takes in, all the works of Shakespeare, or kind of abbreviated set of the works of Shakespeare, and then starts actually printing, new and original works in the style and flavor of it. But it really just shows that the models are not as unique. What really differentiates and will make some of these better than others is the amount of power that you can put behind them. So that will be the difference between something that you kind of hack together on 2-hour tutorial, the difference between ChatGPT or whatever Google comes up with next. And curiously, Google and Facebook really did drop the ball here. It'd be interesting to see how their product goes. So Google announced they're launching Bard. They kind of hoovered up talent in AI and have for many, many years. Facebook was similar. Like, that was like one of Zuckerberg's original kind of loves, but instead he went in the metaverse. Now, my view on Facebook is actually he's going to pivot hard now. He's already announced cost cuts. He's already talking about AI. I reckon Facebook is going to move very, very hard in that direction. And again, just a sign of the demand. So you've got OpenAI, which is one of the best funded startups ever, backed full-heartedly by Microsoft, and their tool is at capacity. So it gives you an indication of the amount of demand for it. The other interesting aspect of semiconductors is that all the governments around the world, or many governments around the world, are trying to foster their own domestic industries, largely because these are critical for defense. So the US, the United States, Europe, Japan, everybody's trying to get their manufacturing out of Taiwan. And obviously China needs to foster their own domestic industry. Now, everybody's kind of banning high-end equipment sales to China. I think my guess is within 10 years that will end up being an error, because China will develop their own industry. It probably works for 3 to 5 years. China's obviously has their own very long history of copying and importing technology offshore. It's kind of impressive, actually, that companies like ASML in the Netherlands have managed to keep their IP so secret. It's probably partly a function of how complicated and how advanced this manufacturing is. What this means is there's huge government incentives going to be thrown at this area. If there's one thing we've all learned over the last 5 years, where government's pointing that hose of money really, really matters. And it also suggests, in terms of where you want to invest within the sector, you really want to be in the companies that are kind of delivering the equipment, they're receiving those enormous, enormous sums of money, both from Google, Amazon, Microsoft, as they meet the demand of this new generation of AI, but also government incentives that will go to companies. It will go to companies like ASML, TSM. It really does kind of indicate where to invest. And again, these companies have sold off significantly, and many of them are down from where they were a year and a half ago, when they're significantly bigger now, with much better prospects, and the kind of negative effects of the collapse in crypto demand is filtered through. We're partway through the PC and mobile down cycle. At some point, people will upgrade their phones and PCs again. And you have this demand increase from AI and potentially this military-driven government investment as well. So it's a super interesting place to be. Companies like ASML, which is our second biggest position now, I think this will become a fund manager darling, for better or worse. But we're buying it because of the fundamentals. There's a down cycle, and they're still selling everything they can. They've got a backlog of orders. They're the only people that make the advanced machines that they make. And there's a whole series of companies in the supply chain above them, below them, depending how you look, that kind of feed into them, that have effective monopolies of their own parts of the value chain. The other thing's interesting is, like, a lot of stocks are breaking out of long-term ranges. So I put Shopify here, went from 160 down to, I think, what was the low? I think it was 35, 40, something like that. And has already advanced, up to well above 50. This chart's actually old. It's rallied further since then. It's in the 50s. So you're seeing these companies that are still down, 60, 70%, but have very much went through a very painful bottoming process last year. In many cases, dropping below COVID lows, in many cases, dropping below where they were, in 2015 or even 16, like in the case of Disney, and just being a fraction of many times the size and a fraction of the market value. But now you're seeing them break above these, long-term moving averages. And the reality is the fundamentals have still been strong, just been grinding through. revenue growth, and Shopify like increased their prices dramatically, 30-35% increases, which really shows the power of these internet platforms. I think Spotify is probably in a similar category where there is so much value they can do just by raising prices. These were kind of the worst places to be. It's kind of the company that we generally like as well. Companies that are growing fast, long history of growth, used and loved and relied upon by many, many people. Like, think about people, how many firms use Shopify, how many people listen to Spotify, the growth in a company like Square. These were the exact kind of companies that dropped 85%. And these, in many cases, kind of drove why we had such a bad year last year, but also like it drive performance in future years as well. There's no doubt there's an immense opportunity in these kinds of companies. Thought I'd put this one here as well. So this is one that caused us a lot of trouble. We went up, I think, 8-fold or something, and then dropped, from 350 down below 50. But finally has been bottoming for quite some time, going through extensive cost-cutting measures and still hitting top-line growth. And you can see that, it's ultimately these things dropped by a factor of, multiples dropped over 90% across the board. There's another one, Mercado Libre. So again, you can see huge multiple compression, but very consistent quality revenue growth. This is still at, multi-decade lows. And there's a similar chart in Square. So again, you can see Square has been bottoming for most of last year. Has finally broken above, in this case, it's a 50-week moving average, but also the 200-day for the first time. Like these kind of momentum signals, they're very crude. Sometimes they work, sometimes they don't, but they did all flash red at the top, and they are all for the first time in recent weeks flashing green. And that kind of makes sense when you pull it all together. So a huge washout in investor positioning, a huge washout in the funds, massive fears of recession, genuine recession in tech. But as it so happens, not a recession so far in the broader economies of the world. And also a decline in inflation, like a real, very strong signals finally acknowledged by the Fed that we are seeing disinflation now. So it isn't too surprising that these have started rallying and are breaking out of trend ranges. Now, the beauty is, as I showed you a chart of what happened the last time things got this cheap, markets rallied for 4 or 5 years, and the returns on an index level in these, like the growth indices, many of them went up tenfold. I'm unsure what happens next, but I do know many of these companies will actually increase in size from the highs to, where they'll be in 2025 by 5 to 10 times, as measured by revenues, users, gross profit dollars. You will see those returns in the fundamentals. And from these low valuation bases, you could see in the prices as well. So to summarize, finally getting disinflation. We've noted it for a few months. Falling prices have been obvious to everybody for quite some time. I think there's a lot of inflationistas who are wrong for 10 years and then very, very right. And there's very few people that will get it, the spike in inflation and then the fall in inflation correct. But funnily enough, the people that did the best work, that predicted the rise in inflation, simply looked at the data, and the data all showed that prices were rising. And it also showed how and why it was lagging and not visible yet to a significant extent in the official numbers. That same approach that predicted the inflation spike now effectively predicted the fall, which meant that, for example, we were kind of calling for this for a couple of months now, and on current data, it's likely to continue. And we're using the same process that people did that got the inflation rise right. At the moment, PMIs and employment are not indicative of recession. Growth stocks are up 30 to 50% from the lows, but it's still down 65, 75%. So there's still a real opportunity here. In many cases, the returns from the lows are spectacular, but in terms of multiples, in terms of where they've traded over the last 10 years, in terms of kind of how much they have grown in terms of revenues and fundamentals, and how much the stock price has shrunk, there's still a huge opportunity here. There's some places that are really interesting. So obviously we're focusing on high growth software. We're focusing on semiconductors, which clearly seem to be leading the recovery. They're boosted by the government. The core computing demand of the world is likely to increase significantly with the success of these new tools. It wasn't guaranteed that AI was going to be this successful. Certainly not now. But it really does feel like magic when you use these tools. And who knows if, Microsoft and Google and perhaps Facebook and others and new entrants will all fight this out. But one thing's for sure, if you want to have a good AI tool, you're going to have to throw immense computational resources at it. And semiconductors, by which I broadly mean kind of that core-based industry that builds the core components of computers. So giving a very kind of broad definition of that, I think is a great place to invest. We're also seeing special situations in the life sciences. I haven't really covered that here, but we did talk about Achieve in our letter. And there are some interesting things there. So you had companies that have dropped 95%, traded for half cash. Now those opportunities have largely gone. There are many companies trading below cash. But there are many companies that have delivered good data that are up 2, 3, 4 times from the lows, but are still trading at, in the hundreds of millions, when the opportunity is really in the billions or tens of billions. And so we are looking pretty closely at a few of those. And if we could recover from this fast or slow. If it's fast, it'll probably because we got some of those right. And then finally, the last time valuations got this low, growth indices went up, more than tenfold within 5 years. I'm not saying that's going to happen again, but I do know that the positioning is much more significant this time than it was in 2016. The sell-off was much bigger. The swing was much bigger. If growth starts to perform again, it already has. I'm not sure that leaves managers. I mean, everyone has long memories now. The 10 years, we've had a bad couple of years in growth, to put it mildly. But, there's like a long history from the 10 years prior to that of growth significantly outperforming. So I don't think anybody who's on the wrong end of that will make the same mistake. Similarly, where in terms of how we're going to change our strategy, we're clearly going to keep the focus on growth, technology, but we are going to be much more focused. I don't think we'll ever sit in a 2-year downtrend the same way that we did. But the lessons from the last 2 years will be most relevant when markets kind of top out again. And that's not really where we are now. Right now, it's kind of the opposite. You've got like a peak in inflation, a peak in central bank hawkishness, not a recession yet. And so actually the opportunity is almost certainly on the long side. And the crazier that sounds, the more likely it probably is to be true. So I might finish up on that. And I'm going to post this to the same channel that I've been posting our other podcasts. Let me know if you have any feedback on that or anything that we're doing at the moment. It would be great to hear from you.